Ladies and gentlemen, good day and welcome to the TCS earnings conference call. As a reminder, all participant lines will be in the listen-only mode. Should you need assistance during the conference call, please signal an operator by pressing star and then 0 on your touchtone phone. After today's presentation, there will be an opportunity to ask questions. To ask a question, you may press star, then 1 on your telephone keypad. To withdraw your question, please press star, then 2. Please note that this conference is being recorded. I now hand the conference over to Mr. Kedar Shirali, Global Head Investor Relations at TCS. Thank you, and over to you, sir.
Thank you, operator. Good evening and welcome, everyone. Thank you for joining us today to discuss TCS's financial results for the third quarter of fiscal year 2023 that ended December 31st, 2022. This call is being webcast through our website, and an archive, including the transcript, will be available on the site for the duration of this quarter. The financial statements, quarterly fact sheet, and press releases are also available on our website. Our leadership team is present on this call to discuss our results. We have with us today Mr. Rajesh Gopinathan, Chief Executive Officer and Managing Director.
Hi, good evening, everyone.
Mr. N.G. Subramaniam, Chief Operating Officer and Executive Director.
Hello, good evening, everyone. Happy New Year.
Mr. Samir Seksaria, Chief Financial Officer.
Hello, everyone.
Mr. Milind Lakkad, Chief HR Officer.
Hi, everyone. Happy New Year.
Our management team will give a brief overview of the company's performance, followed by a Q&A session. As you are aware, we don't provide specific revenue or earnings guidance, and anything said on this call which reflects our outlook on the future or which could be construed as a forward-looking statement must be reviewed in conjunction with the risks that the company faces. We have outlined these risks in the second slide of the quarterly fact sheet available on our website and which has been emailed out to those who have subscribed to our mailing list. With that, I'd like to turn the call over to Rajesh.
Thank you, Kedar. Good morning, good afternoon, and good evening to all of you. We had a very good growth for a seasonally weak quarter. Our US dollar revenue crossed the $7 billion mark in Q3, and revenues grew 19.1% in rupee terms and 13.5% in constant currency terms, and 8.4% in dollar terms. Our operating margin for the quarter was 24.5%, an expansion of 0.5% sequentially. Our net margin came in at 18.6%. I'm very happy to share that the board has announced a dividend of rupees 75 per share, including a special dividend of rupees 67 per share. Including the interim dividends paid out in the first half of the year, this translates into a shareholder payout of rupees 33,297 crores for year till date. I will now invite Samir, Milind, and NGS to go over different aspects of our performance during the quarter. I'll step in again later to provide some more color on the demand trends that we're seeing. Over to you, Samir.
Thank you, Rajesh. Let me first walk through the headline numbers. In the third quarter of FY23, our revenues grew 13.5% year-on-year on a constant currency basis. Reported revenue in INR was rupees 582.29 billion, a year-on-year growth of 19.1%. In dollar terms, our revenue was $7.075 billion and year-on-year growth of 8.4%. Moving to the operating margin, we had a 70 basis points benefit from the currency movement. Operation turn to normalcy. Overall, our operating margin expanded 50 basis points sequentially to 24.5%. Net income margin was 18.6%, impacted by foreign exchange fluctuations. Effective rate for the quarter was 25.7%, effective tax rate. Our accounts receivable was at 66 days DSO in dollar terms, up 4 days sequentially. Net cash from operations was rupees 111.54 billion, which is a cash conversion of 102.8%. Free cash flows were at rupees 102.15 billion. Invested funds at the end of December stood at rupees 669.24 billion. Lastly, as Rajesh mentioned, the board has announced an interim dividend of rupees 75 per share, which includes a special dividend of rupees 67 per share. Total shareholder payouts till date amount to 110% of free cash flows. Over to you, Milind.
Thank you, Samir. You might recall that our approach to overcoming the supply side challenges faced by the industry was to bring in fresh talent at scale and then train them on new technologies. In the prior 6 quarters, we onboarded 135,000 fresh engineers. In Q3 alone, we brought on about another 7,000 fresh engineers in Q3, and bringing in a total of 42,000 freshers year to date. These are unprecedented numbers. Our biggest strength has been the nearly 125,000 TCSs at middle and senior levels who have been with the company for over 10 years on average. They have been central to our ability to culturally and operationally integrate all the fresh talent we brought on board, and in ensuring that the project outcomes and customer experiences continue to be the best in class. Last year, our net hiring was significantly ahead of our revenue growth. Our focus this year has been on utilizing all that excess capacity and making our newest employees productive. Between that and elevated attrition, we had a net reduction of headcount, and our workforce strength as of December 31st stood at 613,974. We continue to have a very diverse workforce with 153 nationalities represented and with women making up 35.7% of the base. On the learning front, TCS has clocked 11.4 million learning hours in Q3, resulting in an acquisition of 1.3 million competencies. LTM attrition in IT services was at 21.3%, slightly down quarter on quarter, but still very elevated as it reflects the high levels of churn in the prior quarters. Our quarterly annualized attrition, on the other hand, fell by nearly 6% in Q3, as we expect it to steadily trend down over the coming quarters. Over to you, NGS, for some color on segments and products and platforms.
Thank you, Milind. Let me walk you through our segmental performance details for the quarter. All growth numbers are on a year-on-year constant currency basis. Growth was led by retail and CPG, which grew 18.7%, led by strong demand in the travel and hospitality segment, while retailers had production freezes during the holiday season. Life sciences and healthcare grew 14.4%. Technology and services grew 13.6%. Communications and media grew by 13.5%. Manufacturing 12.5%, while BFSI, our largest vertical, grew 11.1%. Let me now walk you through the growth figures by geography. Among major markets, North America as well as UK grew 15.4%, while continental Europe grew by 9.7%. Moving on to emerging markets, Latin America grew by 14.6%, India by 9.1%, Asia Pacific by 9.5%, and Middle East and Africa by 8.6%. Moving on, our industry-leading portfolio of products and platforms continued to perform well. Ignio, our cognitive automation software suite, signed up 10 new customers and 7 clients went live during the quarter. The business health monitoring solution from Ignio is gaining traction with customers and went live in over 2,000 stores for a major American auto retailer in Q3. Enterprises are increasing their investment in AIOps and automation technologies to improve employee productivity and resilience. Ignio is uniquely positioned to ride on this particular opportunity with an end-to-end platform that offers self-healing and machine learning ability across customer lifecycle to help them in their journey of being an autonomous enterprise. TCS Banks, our flagship product suite for the financial services domain, had 6 new wins and 7 go-lives during the quarter. We continue to gain share in the market infrastructure institution segment with a new win in Q3. The subsidiary of a leading European CSD selected TCS Banks Market Infrastructure, implementing a unique system offering settlement and correspondent banking services to their customers. One of the largest asset managers in the USA with over $7 trillion in global assets migrated its personal advisory services and digital advice offerings to the cloud-based TCS Banks Wealth Management platform, enhancing their advisor experiences, improving accuracy and low latency responses for performance computation analytics for millions of customer portfolio by record numbers. Our Quartz blockchain platform had 2 new wins and 1 go live in Q3. A Swiss multinational pharma major has increased their adoption of Quartz further, building on the successful initial pilots we executed using blockchain, smart contracts, and digital payments. Quartz Smart Solution for contract performance monitoring and Quartz Gateway are going to be used to eliminate inefficiency in cross-functional manual processes entailing procurement, finance, and treasury. In life sciences, TCS AD, our advanced drug development platform enabled by artificial intelligence, was implemented for 2 leading pharma companies for automation of adverse event intake and processing. With this, TCS AD has successfully completed automated processing of 500,000 adverse event cases. Our offerings in this platform continue to address patient centricity, smart clinical analytics, interoperability, and AI-enabled automation that are emerging trends in the life sciences industry. TCS Optumera, our artificial intelligence-powered retail merchandising suite, went live for 4 clients. TCS OmniStore, our AI-powered universal commerce suite, had 2 go lives. TCS Hubs, our suite of products for communication services, had 1 new win and 4 go lives in Q3. TCS Ion had 7 wins in the quarter ending December. During this period, we served over 35 assessment customers and administered exams for 8.8 million candidates. We reached a new industry partnership milestone in Q3, engaging with 1,580 corporates that leverage the TCS National Qualifier Test as their entry-level recruitment platform. Over 3,700 candidates have gotten placed till date. Lastly, Mastercraft and Giles won 10 new clients in Q3 and 21 renewals. Let me now go over our client metrics. These metrics are an important validation of our customer-centric business model. In Q3, we added 1 more client year on year in the $100 million plus band, bringing the total to 59. 12 more clients in the 50 million plus band, bringing the total to 130. 35 more clients in the 20 million plus band, bringing the total to 290. 30 more clients in the $10 million plus band, bringing the total to 456. 39 more clients in the $5 million plus band, bringing the total to 658. 42 more clients in the $1 million plus band, bringing the total to 1,217. Let me now request Rajesh to speak on the demand drivers during the quarter.
Thank you, NGS. As mentioned by NGS, the seasonality led to some moderation in growth in verticals like BFSI, retail, and technology and services, and across all our key markets. While the seasonal aspect should reverse in the next quarter, the macroeconomic uncertainties are likely to result in a more balanced year in 2023 after 2 years of strong growth. For now, we see client caution translating into greater focus on cost optimization. We are seeing an increase in the number of large operating model transformation engagements. In the first 3 quarters of FY23, we won 20 such deals versus 16 in the prior year, same period. Our innovative approach to redesigning the operations, embedding AI and intelligent automation into individual processes, and using TCS Cognix has been delivering superior outcomes for our clients and a differentiated positioning for TCS. We are also seeing an uptick in vendor consolidation. Our scale, full services capability, and track record of delivering outsized savings through operating model transformation is helping us win such deals. We have won quite a few such deals across BFSI, healthcare, manufacturing, and telecom, and we see many more in the pipeline. Here is a good illustration. The BT Group, UK's leading provider of fixed and mobile telecommunications, announced a new partnership with TCS for its digital unit to boost its modernization plans. TCS will manage and ramp down over 70% of digital legacy technology estate and boost its capacity to accelerate the build of its new strategic technology architecture, supporting the group's growth. Coming to cloud transformation, continues to be a strong area of growth. As I had mentioned last quarter, clients are much more focused on execution of the cloud journeys, and the increased intensity is translating into an expanded opportunity for us. Our strategic industry-specific solution fabric, built on market-leading hyperscaler platforms, empowers enterprise digital transformation and drives exponential business value through industry innovations. We won several new cloud transformation deals in Q3. Here are a few examples. We were selected by Boston Scientific Corporation, a global medical devices company, as a strategic partner for purpose-led enterprise-wide multi-cloud acceleration program. TCS's decade-long transformative partnership will help deliver cloud-native, resilient, and futuristic operations that will fuel Boston Scientific's global business growth and its mission of transforming lives through innovative medical solutions. TCS expanded its partnership with the UK-headquartered international savings and investment firm to help and later transform into a cloud-only organization by 2025 through a series of technology and business transformation initiatives. Leveraging its deep contextual knowledge of the client's IT and business landscape, TCS will help modernize and transform their application estate using cloud-native architecture and seamlessly migrate them to a public cloud using TCS Cloud Council and TCS Migration Factory. This will also simplify the legacy infrastructure estate and facilitate their exit from on-premise data centers. We have been engaged by the largest online travel company to build a unified, modernized enterprise data platform, which entails creating a data lake, abstracting data from transitional systems and other data sources, and building intelligent self-learning engines leveraging AI/ML models and rendering seamless experience to customers and associates. The marketing meta-analytics we deploy will enable greater personalization and tailored recommendations on their portal. Moving on to growth and transformation, we usually talk about G&T engagements focused on the front end, helping clients launch innovative new products and services or new technology-enabled business models or channel improvements and personalization that enhances customer experience. I'll come to those in a bit, but before that, I also wanted to share some examples of how technology-led innovations at the back end can also result in revenue growth and improved customer satisfaction. Predictive analytics, machine learning, and AI are fueling such innovation. Let me illustrate with 3 examples. PostNord, a European-based communications and logistics solution provider, has partnered with TCS to achieve their win in parcels key strategic priority and to be the market leader. A key objective is to transport more parcels per truck in each trip made between the terminals and their regional hubs. TCS developed a touchless AI-based solution using machine vision and, importantly, existing security CCTV cameras to accurately measure the truck fill rate in real time, and leveraged the TCS proprietary algorithm to optimize the line haul planning and truck departures. This has helped improve the revenue yield per truck, reducing the number of trips and the associated costs and even the carbon footprint. TCS partnered a US-headquartered multinational biopharmaceutical company in co-creating and implementing an industry-first AI-based solution to transform the handling of patient complaints about drug-device combination products such as pre-filled injections and auto-injectors. The solution triages complaints and automatically separates out product-related complaints from drug-related adverse events, resulting in faster processing of complaints, timely feedback to patients, and to internal design and the production teams for remediation. This has helped improve product quality, enhance patient experience, and contributed to improved sales of such combination products. Toyota Material Handling in North America engaged TCS to transform its field service team's ability to diagnose and repair. TCS solution enables guided troubleshooting, self-service, and cognitive search of technical product support content using AI, ML, and NLP, which helped reduce downtime associated with unplanned maintenance by 10 to 15%. The transformation has improved first-time right fix, reduced the dealer overheads, and resulted in service stickiness, leading to increased service part sales for dealers and to Toyota Material Handling. M&A continues to be a recurring theme in our customers' G&T agendas. They have been entrusting us with these integration or divestiture mandates on account of our contextual knowledge of the business and IT landscapes, our highly collaborative inside-out approach to transformation, and proprietary accelerators such as TCS Crystallis, a set of pre-configured industry and business solutions available on all leading enterprise application platforms. Here are 3 examples of it. Philips Domestic Appliances, a carve-out from Royal Philips and a global leader in kitchen, coffee, garment care, and home care appliances, engaged TCS as the sole source primary partner to support PDA's transition to an independent entity and its business transformation to become a digital-first and consumer-centric organization. TCS established a digital core for the new business, designed lean business processes, and successfully rolled out the pilot in 7 countries. We are now working towards a big bang go live for the rest of the world. This is expected to be the foundation for a 10x growth in sales through expansion into new markets and channels with 20 million highly engaged customers. Similarly, we are helping a leading North American bank with the seamless merger of a US bank. TCS's deep contextual knowledge and platform expertise was critical for success in this large and complex M&A program involving online banking channels, treasury and payment services, auto and equipment financing, among others. TCS did an end-to-end mapping of the products and processes of the acquired bank and carried out a parity uplift to ensure consistent experience for incoming acquired bank customers. At the back end, we integrated new lending and leasing products into the acquired bank's portfolio and migrated the acquired bank's products, customers, and users to the acquirer's platforms. With the successful integration, the acquirer bank expanded into a large complementary contiguous market in the US, doubling its branch footprint, and onboarded over 1.5 million new customers and inherited a strong commercial business with a high-quality loan portfolio. Finally, in Q3, we were chosen by a European life and material sciences company to lead the global integration of one of their largest acquisitions. TCS is responsible for end-to-end integration of warehouses and factories. It will set up a transformation management office to enable faster realization of synergies and serve as the foundation for future M&A. Let me now provide a few examples of TCS partnering with clients to use digital technologies to help launch innovative new products or services that drive new revenue streams. A leading US headquartered media and technology multinational partnered with TCS for building a single digital ecosystem platform spanning home entertainment and mobility. As the sole strategic partner, TCS was responsible for the full life cycle of the new technology platform for this new business line. TCS designed and implemented the solution through an API grid for the entire ecosystem, leveraging AI/ML for agile operations, proactive care, proactive service management, and preventive fault management. The new business model helped deliver truly personalized and unique customer experiences to end customers of the client. It recently crossed 5 million customer connections and witnessed high NPS scores and customer satisfaction ratings. Similarly, TCS helped the leading US money transfer service provider transform its technology estate into a modern cloud-powered platform, enabling it to launch new products faster, expand into new markets, and strengthen its customer relationships. Leveraging the new integrated next-generation multi-currency digital wallet and digital banking platform, our client has forayed into digital banking in Europe, offering customers access to a variety of differentiated multi-currency payment services in a single app. The new platform has also helped the client successfully integrate with cross-industry ecosystem partners to offer millions of customers greater ease, reliability, and access to money movement and payment service capabilities. Overall, the transformation has resulted in increased customer loyalty, reduced customer journey barriers, and created new revenue streams. Similarly, in Q3, an APAC-based automotive electronics manufacturer chose TCS as their co-innovation partner in developing next-gen instrument panel clusters. TCS services will span product development, HMI or human-machine interface, functional safety, cybersecurity, and other cockpit-related products. In prior calls, I've been giving examples of how TCS is participating in large industry transformation initiatives. Now, again, in the utility sector, we have had several examples of TCS helping utilities and power producers navigate energy transition. Our domain expertise and track record in executing successful transformation is firmly enabling us establishing us as the preferred G&T partner in the sector. Here's one more example of the same. Western Power, a leading Australian power generator and distributor, selected TCS for our credentials in this space to design, deliver, and support a distribution system operator platform solution. Our solution enables the client to orchestrate distributed energy resources or DER, such as rooftop solar, batteries, and large appliances across homes and businesses into a virtual power plant, aggregating the excess electricity generated by their assets and then dispatching it into what will become new energy markets and services. The TCS solution also addresses the critical issues like low voltage network visibility and optimization. With over 650 participating customer energy assets till date, the platform has demonstrated the safety and reliability of aggregated DERs and helped the client model the complexity of bidirectional energy flows. This will open doors for Western Power to participate in the futuristic energy market and build new revenue streams while safely operating within the technical limits of the distribution grid. Likewise, we are participating in longer-term transformation trends in the transportation sector. Last year, I had spoken about the work we are doing for Transport for London to transform the administration of taxis and private hire vehicles in London to prepare it for an electric and autonomous future. So in Q3, we won a deal that will transform the railway sector in the UK. TCS was chosen by the Rail Delivery Group, UK's leading rail industry membership body, for the creation of a rail data marketplace. TCS will leverage data syndication, monetization, and marketplace features of its DEXAM platform and the cloud-native platform of a leading hyperscaler to combine fragmented sources of rail data into one digital service. This will optimize the sharing of data and real-time information to passengers and operational bodies, improving the transparency and enable a UK-wide railway innovation ecosystem. Let me now come to the Q3 order book. Our deal closures in Q3 amounted to a TCV of $7.8 billion. By vertical, BFSI had a TCV of $2.5 billion, while retail order book stood at $1.2 billion. The TCV of deals signed in North America stood at $4.2 billion. With that, we'll open the line for questions.
Thank you very much. Ladies and gentlemen, we will now begin the question and answer session. Participants who wish to ask a question may press star and 1 on their touchtone telephone. If you are using a speakerphone, please pick up your handset while asking a question. This is required to ensure optimum audio quality on the call. Should your line have any disturbance, you may be asked to return to the question queue if you do not have a clear connection. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question comes from the line of Kumar Rakesh from BNP Paribas. Please go ahead.
Hi. Thank you for taking my question. Wishing the team a very happy new year. Hope 2023 be a great year for you. My first question was to better understand the headcount moderation during the quarter. During the press conference, Rajesh, you talked about the focus on headcount efficiency to continue in fourth quarter as well. Now, assuming the headcount stays steady in fourth Q, you will be exiting the year with a headcount growth of about 4% YOY. So my question was, is that an indication of growth visibility that you have today, or and hence the rationalization, or you are confident of driving similar or higher productivity gains, and hence revenue growth could be significantly higher than that?
Rakesh, a very happy new year to you too. I think the best way to think about it is that on a year-on-year basis, our net headcount is about 55,000 or so people. So we have significantly invested in building up capacity in 2021, tried as much as possible to bypass the industry's hire from each other attrition cycle, and focused on hiring at entry level and invested in training and cross-training our resources. That investment has hit our productive capacity and stood us in stead. So, the incremental hiring that we saw this year should be seen in context of what we've done in the last year also. And overall, we are very comfortable with where we are with our net headcount. We hired significantly ahead of revenue growth in 21 and balanced it with a more prudent hiring in 22 or 23 FY calendar 22. Going forward, we should be back to a more normal kind of hiring trend. While specific numbers will keep evolving, we should be expecting hiring in the range of gross hiring in the range of probably in the 125 to 150,000 for the year, and offsetting it with a more expected normalization of attrition levels to our long-term averages, which will give us sufficient capacity to take care of growth, and then we can keep bringing in shorter-term hiring to take care of demand as it unfolds. So that would be the best way to think about and model it.
Got it. Thanks. That's very helpful. My second question was on the deal side. So you talked about that cost optimization deals have already started picking up meaningfully. Now, in the past, during recessions, we have noticed that first there's a sharp cut to IT budget before cost optimization deals starts picking up. I understand that visibility on client budget is still a couple of months away, but do you think this time the transition from discretionary IT spending to cost optimization deals could be far smoother than what we have seen in earlier recession periods?
It's also a factor of how it is playing out in different markets. So as I said, if you take a market like UK, that is well and truly into much more strategic, long-term, cost-based restructuring kind of deals. And we are seeing multiple such ones play out, and we are participating very strongly in that. Market like US is more, we need to wait and watch how that will play in the next couple of quarters, but we are fairly constructive, and our conversations with customers, it's a much more balanced one where they are equally positive as well as cautious, and we should see a mix of both cost and transformation deals. Europe decision making is slow, so it's very difficult to call it one way or the other. So this is not is not some major single event that has happened globally. All three markets are moving to three different beats, and each of them are indexed to their own specific outlooks.
Got it. Thanks a lot.
Thank you. Our next question is from the line of Vibhor Singhal from Nuvama Equities. Please go ahead.
Yeah, hi. Thanks for taking my question. I hope I'm audible. Congrats, Harish, for a great performance in a seasonally weak quarter. So, Harish, I just wanted to basically pick your brain on the performance of the retail segment in this quarter. I think the segment has outperformed the company average growth rate also, and doing really well here. While globally we are hearing about a lot of these retail chains calling out weakness, especially in European parts as well. So any color on that would be helpful as to what drove this strong performance in this quarter. Is there some do you expect this to sustain in the coming quarters also? And also, is there some color to it in terms of, let's say, US retail maybe doing slightly better than Europe retail, as you just called out that in Europe the decision making is slow on an overall basis?
Okay, let me answer it as best as I can. First of all, the numbers that we show in retail is a combination of retail, CPG, travel and hospitality. So that's the industry group that we report on. Within that, if you look at it, travel and hospitality is enjoying a very strong rebound after a very, very challenging couple of years. And we are one of the largest, if not the largest, service provider in that industry. And we were significantly impacted in the last couple of years. And also we are now participating in the upturn also quite handsomely. The CPG sector continues to, it's going through multiple forms of transformation, mostly led in various forms on direct-to-customer channel strategy transformation, and significant investments going into that. And there also analytics, sustainability, direct-to-customer. Each of these themes are continuing to find a lot of traction and continued investment, and we are participating in all three quite well. Retail itself is more regional, and different markets have different focus. Plus, within retail, grocery as a segment continues to do well. More of discretionary retail is, as I said, market specific. Going to the last part of your question, US retail sales adjusted for inflation itself still have come in stronger than last year, and last year was a very strong year. So overall, from a volume perspective, retail in US has done well. However, profitability has been challenged both by customers walking down the product line in terms of preferring a slightly cheaper product on a relative basis, as well as the fact that cost structures have been up. So profitability for many retailers has been under challenge, and we need to wait and see how this will translate in. But some of those costs are transient. Some of them will require more structural cost transformation deals. So it's a fairly complex set of drivers in there. it goes back to what we have always said. We stay close to the customer and we play each customer and each scenario on a one-on-one basis. And overall, we believe that the industry continues to be very attractive, and we have the full suite of capabilities to be participating across this broad spectrum and to make sure that we stay relevant to customers on a very individualized basis.
Sure. Thanks for that very detailed and comprehensive answer. If I could just maybe drill down a bit more, since you touched upon the travel and hospitality segment. As you mentioned that we bore the brunt of it while COVID struck and the segment was down, and now we're seeing a strong rebound in the segment. I think globally also, as we are seeing very strong bookings in Greece and Spain, and baggage scan data also come up. So do you expect this momentum to maybe continue in the travel segment in the coming quarters as well? Of course, this is such a forever, assuming no more waves and no more lockdowns and everything. But do you expect this momentum to continue in this segment in the next couple of quarters, given that these clients would now probably start spending more on tech?
I think so. Of course, caveat is of course that there is no major event that happens, but if things continue as they are, we expect that the sector will continue to do well. There is the demand side. In fact, the sector is supply constrained, and as more capacity comes on board, they should continue to do very well. More importantly, while they did a great job dealing with the pandemic, many structural changes that need to be done have been identified, and those are longer-term programs that will need to be put in place. So we expect a lot more of preparatory investments on the more forward-looking customers, and very high profitability during the course of this year will give them that war chest that is required to make sure that they make the investments for increasing the resilience of their network and resilience of their operation in any future potential scenarios.
Sure, great to hear that. Thanks a lot, Rajesh, for taking my questions, and wish you all the best.
Thank you. Our next question is from the line of Sudheer Guntupalli from Kotak Mahindra Asset Management. Please go ahead.
Yeah. Good evening, gentlemen. Thanks for the opportunity and congratulations on better.
Technology adoption cycle, and but the focus in terms of actual enterprise investment to execute on those transformations will continue. So lesser number of platforms, greater focus on larger programs, much more calmer technology environment is typical for this stage of technology adoption cycle. So probably that also kind of reflects the difference between the product space and the services space. But beyond that, I don't think we have any greater visibility.
Sure. And my second question, the broad agreement by now is that growth for the industry in FY24 will revert to pre-COVID levels impacted by macro issues and the unwind of COVID pull forward impact, etc. Keeping aside the negativity around the near term, how do you think of the medium-term growth prospects for TCS? I'm not asking for a hard guidance, but do you continue to believe that once this near-term noise around macro, etc., is in the base and behind us, growth rates can again accelerate back to double digits, which has been our medium-term aspiration?
We believe so. We believe that our stance is quite positive. And as I said, if you take market by market, US, we definitely think that that's the scenario. UK, we are participating very well. Market itself is challenged. Europe, once the geopolitical situation calms down, we believe that we have the full suite of capabilities to be able to participate. And once decision-making starts, we should be participating well. So overall, we're quite confident about, again, as I said, having the full suite of services to be able to be relevant to customers across a wide spectrum of actual scenarios. And therefore, we are quite confident about the medium to long-term outlook.
Thanks, Rajesh. All the best for the future.
Thank you.
Thank you. Our next question is from the line of Pankaj Kapoor from CLSA. Please go ahead.
Yeah, hi. Thanks for the opportunity. I have two questions. First, Rajesh, you mentioned that the higher share of cost takeout deals which are now coming in the pipeline. So just wanted to understand if such deals are also moving faster in terms of decision making, and any color if you can give on the competitive intensity for such deals. I mean, is it normal, or are you seeing such deal getting more competitively bid now by other vendors?
Speed is varying by market. I could say that UK decision making is quite fast. Customers are very clear, and there is a lot of action happening there. US is normal. It continues to be doing well, but that does not account for the short-term kind of aspect of that market. Everybody is a bit cautious for the time being, but we don't think that will last into next year, but we'll see. In a 3 months' time, we should be able to know better. Europe decision making has significantly slowed down, so that's the full spectrum there. But in terms of competitive intensity, many of the deal structures are quite complex, and that kind of narrows down the field to a more limited set of competitors. Within that, obviously, people are aggressive and everybody is hungry. But at least the competition set is a much narrower set than even a few years ago when deals were smaller, and there was a lot more focus on immediacy of response, and the supply side was challenged.
Understood. And my second question is on the special dividend. With this, you would have almost paid out the entire of the amount that we paid last year, which included a buyback. So does this mean there is a rethink in terms of the mode of capital return in favor of dividend versus buyback?
No. You should, rather than look at it in absolute terms, on INR terms, we are growing at 15% plus kind of basis. So if you consider that growth, we are still benchmarked to that 80 to 100% of net profit or free cash flow kind of a trajectory. Not much of difference to that. Okay.
So a buyback remains something which a board can consider whenever the window opens up.
As you know, the current regulations require a 12-month gap between the two buyback announcements. So there will be no. So that's not. The buyback will be considered when it becomes, what should I say, possible from the regulatory perspective. Right now, we are in a period where we couldn't anyway consider a buyback.
Understand that. Thank you so much, and wish you all the best for FY24.
Thank you.
Thank you. Our next question is from the line of Sandeep Shah from Equirus Securities. Please go ahead.
Yeah, thanks for the opportunity. Rajesh, one broader question at an industry level. Where are we in terms of the cloud transformational journey or adoption by the enterprise client? And do you believe the pace of the adoption can change starting from CY23 onwards, irrespective of the macro issues?
Cloud adoption journey is, I would say a third of the way in. Different customers have different challenges there. Some of them who have gone very rapidly to the cloud, mostly lift and shift, are realizing that unless it is architected right, cloud costs are actually quite difficult to manage. And it's a fairly large bill that can come if you do not architect and if you do not actively manage the cloud environment. So some of the transformation activities and projects that we are doing is to actually help them execute that transformation agenda so that their application stack is architected in a manner in which it can fully leverage the variability that the cloud model offers. Unless you're able to actually switch off and release the resource, you will not participate in the variability. And to be able to do that, you need to be able to architect your application properly so that resource dependency can be switched off on a variabilized manner depending on what your requirements are. So that's one kind of work that is going on. The other kind of work that's going on is actually the migration itself of complex workloads requires a lot more heavy lifting. And that is the other kind of an area that there's a lot of work going. So neither of them are easy to execute. So you should not expect much acceleration. It is more, as I said, the next couple of years is going to be about execution, rigor, operational capabilities. But it will be a steady move. It will not, neither is it likely to accelerate significantly, neither is it likely to decelerate or fall off. If the movement is committed, the direction is very clear. The investments are in place, the deals are in place. Now the execution and the operations has to happen. And that's likely to be the story for the next year or two.
Okay, this is helpful. Just a question in terms of CY23 IT budgets. So do you believe the spend of the IT budgets could be conservative in the first half of the calendar year versus the second half, or you expect the spend to remain normal like any other year, though the budgets may be slightly lower versus the earlier last 2 years because of the macro slowdown?
Again, going by market, in UK, unlikely that it is any different than last year because there is no incremental shift to the overall environment in UK. US, we'll have to wait and see how the next couple of months plays out. We are positive, or rather we are hopeful, but we'll have to actually wait for actual confirmation to come. We think that the immediate caution that is there probably will dissipate a few months into the year. Europe will have to wait for some major event to happen for it to change. Europe will be incrementally cautionary this year compared to last year.
Okay. And just the last bookkeeping question. I think this third-party pass-through cost increase this time does not relate to the domestic revenue. If I'm not wrong, it relates to the international revenue. And will it be a growth headwind in the fourth quarter if it doesn't repeat?
So third-party costs, actually, you could link it to the domestic revenue. There has been a sequential increase in domestic revenue. And typically Q3 has some bit of it coming in. That's where on a year-on-year basis, we don't see that big jump.
Okay, thank you.
There's a jump.
Okay, thank you and all the best.
Thank you. Our next question is from the line of Ravi Menon from Macquarie. Please go ahead.
Thank you. Congratulations, gentlemen, on a good quarter. So regional markets and other segments had seen an acceleration year-on-year growth versus last quarter, despite relatively muted growth in India. Should we think that this comes from improved traction in the insurance BPaaS area? I think NTS mentioned 16 go lives in the quarter for banks. Any large deals here that you'd like to call out, or maybe also share some comments on the deal pipeline in the segment?
I'm sorry, I didn't hear you properly. Could you repeat the question?
Ranjit, you talked about 6 new go-lives this quarter for banks. Just wondering if there are any large deals in the BPAS segment in insurance, and how the pipeline is shaping up there.
Yeah. So one of the areas where we are seeing opportunities and a significant pipeline is the area of digital core, whether it is banking or capital markets or insurance. And all of them are looking at putting together a new digital core. And it was going through a lull period the last about 2 years or so. But then clearly now people are thinking about a new core banking system or a new security settlement system, which are really architected for the future, which are cloud native, which are inherently microservices, or inherently comes with that capability of a marketplace with a significant amount of APIs and microservices that will enable them to integrate into the ecosystem. So as you may see now, during this quarter we announced a large deal win with the China Trust Banking Corporation, which is really the future core, right? In terms of architecture, in a fashion that it is cloud native and it is truly providing open banking APIs and so on and so on. Such opportunities are opening up, and as we see, at this moment, we're working on 3 or 4 such opportunities where some of the larger banks are looking at modernizing their core in favor of something which is a completely open banking, open APIs. And so are some of the market infrastructure institutions trying to create an open payment system. And some of them typically say that whatever you guys have implemented in India, when you offer this whole instant payments, digital payment infrastructure in our geography. So these are opportunities that are coming our way. And there are decent number of opportunities and pipelines that we see in banking as well as capital markets.
Thank you. And SG&A travel costs have increased sharply. How close to normal, Samir, do you think we are in business travel? I think we are still about 30 bits below what we used to clock pre-COVID. So should we think of travel as a continued headwind, or you think we'll stabilize at this level?
Yeah, as normalcy continues to get through, we would expect travel costs to continue to increase. If you look at it more on the direct revenue side or the direct cost side, a lot of it is coming in. But on SG&A, as things open up, more on sales-related costs as well as team building exercises and all team meetings happening, that cost is increasing. We're see it going back towards what it was on the pre-pandemic.
Great. Thank you, and best luck for FY24.
Thank you. Our next question is from the line of Abhishek Kumar from JM Financial. Please go ahead.
Yeah, hi. Thanks for taking my question. I have a question on budget. Rajesh, you mentioned, US, there's a wait and watch mode, and therefore budget could take some time. Is there any possibility that because of that there was probably a little bit of budget flush in 4Q which could have supported the growth?
Sorry, budget flush due to what?
There is possibly an indecision or wait and watch mode for CY23 budgets. So to exhaust CY22 budgets, was there any possibility that there was a budget flush to exhaust the previous year's budget?
No, I don't think so. It's more of the CY23 will be slightly delayed in its initial couple of months till people clarify. But again, it's entirely in the realm of speculation. So we'll have to just wait and see how it plays out in the next few months.
Okay. Another related question to this is, given this little bit of indecision in US, do you think the cost takeout projects in US probably would be low compared to other geographies. At the same time, spending on discretionary would be cautious, and that would probably keep the budgets little low.
Yes, fair assumption. Even if you look at our US TCV, that is down both sequentially and on a year-on-year basis. So that TCV still reflects that decision-making lag in this quarter.
Okay, yeah, that's very helpful. Thank you so much.
Thank you. Our next question is from the line of Gaurav Rateria from Morgan Stanley. Please go ahead.
Hi, thank you for taking my question. So firstly, Rajesh, is it fair to believe that the ACV growth could be lower than TCV growth as a mix of the deals are changing? And should that be even considered as a lead indicator for growth going forward? Or you think the deal win trajectory could actually shift upwards over the coming quarters?
I don't have a direct answer to that, but there is not much of change in terms of the mix of deal structures between large or small or long-dated or small-dated. So nothing that we can call out over the last 2-3 quarters that we can say that we're seeing there is an elongation in decision-making, which we had spoken about last quarter also, and which has also played out this quarter. So that the pipeline growth and the qualified pipeline growth is ahead of the actual TCV growth that we're seeing. In fact, we've seen a sequential decline in TCV while our qualified pipeline still continues to grow in absolute terms. So beyond that, the specific mix of deals is not materially changing.
Got it. Secondly, on the margins, as headwinds on attrition subside, would our immediate priority be to take margins back to our aspirational band of 26-28, or would we prefer to prioritize some investments, keeping margins stable after recovering it to 25%?
So, Gaurav, our margins or our industry-leading margins are on the back of the investments which we make, and most of our investments, whether it is in terms of talent, in terms of research and innovation, branding, all are factored into the P&L. And our aspirations for the margins are taking into account all these investments.
Got it. Thank you.
Thank you. Our next question is from the line of Ashwin Mehta from Ambit Capital. Please go ahead.
Hi. Thanks for the opportunity. Rajesh, one question. We've seen pretty strong growth in regional market and others over the last 2 quarters. It's of the order of almost 6% sequential. So what is the nature of demand here, and how sustainable is this going forward?
The reason of calling the segment out is because it's volatile and difficult to predict. So that sustainability is difficult to answer. From a nature perspective, it's come both from the market side. India has done very well. In fact, APAC ex Australia and also has done well. So markets have done well. As also the product side of the business that NGS spoke about on the FS and platform side also has done well. So it's come from both sides, both markets as well as from the product side.
Okay, fair enough. And the second question was that you mentioned in the press conference as well that manufacturing has been more resilient compared to your expectations. So any trends that we can take from manufacturing, given the fact that if you look at client financials, manufacturing growth over the next 2 years is expected to be actually better than what it was before.
Yeah. Well, that I didn't know that, but that correlates to what we are also seeing. But I'm still wary because all the global supply chain disruption, energy price disruption, industries like process manufacturing are much more globally integrated, so they're not as sector by sector isolated as, let's say, retail. So we are still cautious, but our operating approach is always the same. Stay close to the customer, deal with the customer on a individual opportunity to opportunity basis. And we will continue to participate on that basis. But on a zoomed out way, talking to customers, it is an industry that's not completely out of the woods.
Okay, fair enough. Thanks, Rajesh, and all the best.
Thank you.
Thank you. Our next question is from the line of Rahul Jain from Dolat Capital. Please go ahead.
Yes, hi. Thanks for the opportunity. Basically, my question is related to TCV signing, which at 7.8 billion is slightly lower by our recent average wins, despite the fact that we have been favorable situation on the vendor consolidation exercise. So what explains this mismatch? Is it because such deals are about to do more for the same, or it reflects weak demand in Europe as articulated earlier?
I think it's a combination of everything. It's a delayed decision making, but TCV will not be as linear as revenue, which is why we are given a band of saying 7 to 9 billion is what we think the TCV will remain on during the course of this year, and it has stayed well within that band throughout for the last 3 quarters.
Right. And just a clarification on this retail deal that we announced separately, is it also reflecting the entire retail CPG, or it is only retail specific?
1 second. Retail TCV. Retail TCV, does it include CPG?
Oh, yes, it does. It does. Also TTH. And TTH.
Okay. Thank you so much.
Thank you. Ladies and gentlemen, that was the last question. I now hand the floor back to the management for closing comments. Over to you, sir.
Thank you, operator. We are pleased with the performance in a seasonally weak December quarter, growing at 19.1% in INR terms and 13.5% in constant currency. Our order book was good, but softer than in prior quarters, reflecting the cautious stance that many of our clients have taken. Our operating margin expanded sequentially to 24.5%, and our net margin was at 18.6%. On the people front, LTM attrition in IT services fell slightly to 21.3% and should continue to taper down in the quarters ahead. With that, we wrap up our call. Thank you all for joining us on this call today. And I must say that you are a very mature and knowledgeable group for having resisted asking us about the impact of ChatGPT on our industry. Enjoy the rest of your evening or day and stay safe.
Thank you, members of the management. On behalf of TCS, that concludes this conference. Thank you for joining us, and you may now disconnect your line.